let's start with what we're looking for next week in terms of economic releases in the market. So on Tuesday, we have existing home sales. On Wednesday, we have PMI composite flash, new home sales, and then the EIA petroleum status report. On Thursday, we have durable goods orders and jobless claims. And on Friday, we have the big Jackson Hole speech, which includes Jerome Powell. So this is going to be a pretty eventful week with a lot of the waiting at the end of the week. Obviously, everyone wants to see what Powell's going to say, specifically because last year, Powell's speech was pretty much a market top timer and the market reversed hard from there. So everyone's kind of thinking, well, maybe we'll get that again. So let's go over what happened in the market last week. So the NQ closed down over 3%. Obviously, equity indices went lower, specifically the NASDAQ. Now, the NASDAQ is also down over 8% from the regional high that we put in earlier this month, or excuse me, at the end of last month. Now, a lot of people are saying, okay, that this is the end of this entire bear market rally. Obviously, if you're not new to Market Radar, you know what we've been saying. Bullish trends aren't bear markets. So the NQ has been in a bull market since March of this year. So obviously, bull markets tend to lead to higher prices. We do not short bullish trends. Now, NQ can stay bullish all the way down to Momo, meaning it can come down another 4.5% and possibly bounce off Momo, continue higher, and remain in this bullish trend. So don't underestimate this downward slide in the pricing. It doesn't mean that the bull run is ended. Obviously, the only thing that can end a bull run or a bullish trend is an opposite neutral or bearish trend. So we have to pay attention in terms of trends, where we're seeing the market going, to evaluate if price is going to continue. Now, a lot of commotion was generated this week around the Fed GDP nowcasting model. So for those that don't know, the Atlanta Fed has a model that they update every so often, and they give forecasts of where they think the next quarter's GDP print is going to be on a quarter-over-quarter percentage change basis. Now, the big thing here is for the third quarter, we moved from 4% just a few readings ago to nearly 6% GDP growth. So everyone's thinking, well, wow, the economy is really hot. Okay. And everyone's looking at this and saying, well, if the economy is really hot, the Fed will have to be restrictive for longer. Now, we have to pay attention here because this is a nowcast model, right? So this model is going to incorporate data as it's released, predicting the end result. The end reading for quarter three is still quite a bit away, and there's a lot of new data that can change this forecast. We're still early in the nowcasting section of this data series, and then things can progress and change throughout each subsequent data economic release that affects this nowcasting model. So don't take it for granted that we're going to get 6% quarter-over-quarter GDP growth in Q3. Just take it as that's where Atlanta Fed is seeing it now. And obviously, there are other estimates out there, but generally, the market is obviously not blind to this. It knows what this is pricing, and it can pick up on this and price this in as well. So, could that be why equities reversed into Friday? Could it be the OPEX? A lot of things are at play there. But long story short, GDP is hot, or at least the nowcast model is hot, and therefore, this idea of the soft landing lives on. Now, with this idea of the soft landing, let's bring up bonds. Bonds did not do so well in the last week, but they didn't do as bad as equities. They're only down about 1.5% long bonds, I'm speaking of, or close to 2%. And in the last month, they're down about 6%. So all in all, bonds have slid lower. They are lower in the week, but they seem to be holding up a little bit here on the 119 mark on ZB. Now, what's going on here is, again, the idea of the soft landing taking hold into the market. Now, for those that are new to Market Radar that don't understand the soft landing, I'm going to break it down in a very simple and perceivable way. So, obviously, the soft landing is the idea that we can control the inflation situation and bring it under control without destroying the labor market. Now, the problem with that is it's essentially impossible because you're assuming that you're going to restrict the economy enough to bring down inflation without actually destroying the labor market in the process, which is demand slash growth. Now, it's theoretically possible, right? But the problem is the Fed is dealing. The Fed always is, but even more so this time, dealing with immense amounts of lag in their policy. We're under one of the fastest rate hiking cycles in modern history. The Fed is not even sure to the degree of which their policies lags or to where their policy lags are sitting at the moment. So they don't even know the basic consequences of their policies of their policy enactments over the last 12 to 18 months. They still have no idea what that is. So again, they are running blind. Therefore, we can't expect them to micromanage the economy and basically thread the needle on such a precise thing when they don't even know the consequences of what they've just done. So, all in all, soft landing is theoretically possible, but I think it's going to be impossible this time, the way everything's moving. Now, let's talk about the soft landing itself, right? When we say that our saying at Market Radar is the impossible soft landing will continue until all faith in the hard landing is lost. Now, what does that mean? Well, everyone for the last 12, I mean, we can go all the way back to when the market started falling apart and here in NQ back in 2022, right? Everyone's like, oh, the recession's here, the recession's here, the recession's coming. Long story short, the recession never came. Now, it did get priced into equity prices, but it actually never materialized. Now, what happened with bonds were, again, the type of recession the market was looking at was an inflationary recession where inflation was out of control. The Fed hikes would have to restrict the economy, and equities were pricing forward the potential for earnings multiples to get, or they did technically get compressed because of higher short-term interest rates. And then if you look at the DCF models, all these things get, and in terms of the risk-free rates for all these companies, so on and so forth, they get compressed, they expand, which increases the cost of borrowing and then affects company profits, therefore bringing equity prices down. This was all going on in 2022. Sounds really complicated. You can keep it real simple. Inflationary recession. Bond market, on the other hand, has to deal with inflation. Fed rate hikes, inflation uncertainty drove bond yields up very aggressively. No one knew where the peak in inflation was going to be and where the Fed would have to stop hiking rates at. Things have become more clear now, but bonds are still in a bearish trend. Now, why is that? And this goes back to the soft landing, right? So if the soft landing is going to materialize, which, again, remember our mantra, the soft landing will continue until all faith in the hard landing is lost. Everyone wants a soft landing, right? Because, well, the masses want a soft landing. They want to see stocks go up, right? Most people in the market are bullish overall. Long-term investors, you take them out of the equation. If you look at day traders, you're going to get bears and bulls left and right. But the average investor long-term is bullish. They want to see their money grow. And you don't grow money long-term by shorting markets. You have to be long, right? This is the way the market works over time. So most people are bullish. They want the soft landing to materialize. Now, the problem with the soft landing is its effects on long-term interest rates. Now, the idea of the soft landing, as I said earlier, was bringing down inflation without destroying the labor market. So if I were to tell you that, well, if inflation comes down, the labor market's not destroyed, the Fed could just slowly cut rates. So why would bond yields go up on this idea of the soft landing? Well, the issue there is if the soft landing plays out, what ends up happening is you have a higher neutral rate of interest in terms of if this is where the Fed is able to balance the economy in this miraculous soft landing, well, that means the neutral rate of interest is nowhere near where it was previously perceived at 2%. It must be much higher. So the long end has to compensate for that. And this is where I'm going to coin a new term, and I'm going to call it the compound landing. So the compound landing is exactly that. It's the combination and the compounding of both the soft and the hard landing. Ties back into that mantra. Remember the original mantra. The soft landing will continue until all faith in the hard landing is lost. So once everyone's baked into the soft landing, that's when you get the hard landing. The reason for that is as follows. So as we put the compound landing together, both aspects, soft and hard, and combine them for the compound, you need to first have this soft landing materialize. Now, for it to materialize, you need this disbelief in it before you get the belief in it, right? The idea that the soft landing's been hated pretty much this whole equity rally up. It's impossible. We're in a recession. And that's what we have, basically a risk-off economic data environment, whereas growth maintains its a sustained path of basically gliding by, which it did earlier this year, and start accelerating, which it's doing right now. And that followed or accompanied with positive equity index trends. So, for example, NQ is still bullish, right? The idea that the soft landing can materialize is very easy when equity prices are going up. This builds faith in the soft landing and takes faith away from the hard landing. So, as this evolves, what ends up happening is you get this idea that as the soft landing theme gets priced into the market, rate cuts will have to be removed from the market, right? Because, okay, if we're not going to get into a recession and and we have a higher rate of neutral interest, meaning the baseline for restrictiveness is higher, you can't have rate cuts right away, because if you tame inflation without breaking unemployment, then you start cutting rates because inflation starts going down. Well, all you're going to do is stimulate the economy that's already tight. So the Fed is almost landlocked in a soft landing scenario where they can't reduce rates. Again, pushing out expectations of rate cuts and therefore lifting the long end of the Treasury curve. Now, as we push rate cuts further out on the curve, you have to understand the aspect of why the yield curve is inverted. So let's look at the yield curve right now. And this is a simple one. Everyone loves this one. It's the 10 and 2s. We talk about it all the time, and it's very simple to understand. It's 10-year minus 2-year, and this should be a positive spread, meaning if you're going to lend out money for 10 years versus 2 years, you should get paid more for 10 years than you do 2 years. It's negative, meaning you get paid more to lend out for 2 years rather than getting paid to lend out for 10 years. So obviously there's a problem here, and the yield curve is inverted. All that means is the front end of the curve is paying more in interest than the back end of the curve. Now, in a soft landing scenario, what happens, again, let's lift that baseline level of interest where we're not restrictive enough to cause a recession, but we are to tame unemployment, meaning we've hired that baseline of interest where we are on the front end. So call it the 5.25, where the Fed is right now, baseline. Well, if that's the case, then the long end needs to lift, because if there's no recession and the Federal Reserve isn't going to cut rates because the level of restrictiveness is actually higher, well, then the long end has no business trading 69 basis points against a negative 69 basis points against the front end, because there's no demand for the long end at these prices, because there's no anticipation of a recession. The reason the long end inverts like this against the front end, where the long end yields are below the front end when the Fed is hiking interest rates, is due to the fact that everyone has this idea, okay, the Federal Reserve raised to 5% today, in the next, or will be there for the next 3-4 months, but they're not going to be at 5% for the next 10 years. But if you materialize a soft landing, you start giving the market this idea, well, maybe this economy can accept higher interest rates over longer durations. And if that's the case, then interest rates on the long end that are below the front end, meaning interest rates going out further in time, should be more than where they are right now. And what's going to happen is you're going to start to see that yield curve slowly revert, but that's not the true reversion. Reversions happen in two ways. And a reversion is, for those that are new, is when the yield curve goes from negative to positive. That's a reversion. The inversion is from positive to negative. It's usually the reversions that signal the recessions, not the inversions. Now, how does a reversion happen? A reversion typically happens through what's called a bull steepener. Now, what a bull steepener means is the front end of the yield curve. Picture a seesaw. On the left, you have the front end. On the right, you have the back end. When the yield curve steepens, meaning it starts sloping higher, up and to the right, the front end is usually getting cut because we're in a recession. The Fed is reducing interest rates on the front end. And therefore, the back end is staying relatively the same or going down a little bit, but it's not going down as much as the front end, and that's called a bull steepener. On the other hand, we have what's called a bear steepener, which is what we're looking at right now, where the front end remains fixed, where the Federal Reserve is just holding policy, but the back end starts lifting. Now, the bear steepener is not usually what we see in this point in time. What we usually see is the bull steepener and then the bear steepener. But the bull steepener is the recession. So if you take the recession out of the equation, typically what happens next is the bear steepener. There's no recession, there's no bull steepener because the Fed's not cutting rates. Then you get this bear steepener. Now the bear steepener can be fueled by many different avenues of things. If it's demand, or if it's supply, or it's just normalizing higher interest rates. Long story short, long ends go up in bear steepeners. Now, I know you guys are probably listening and saying, wow, that means inflation's got to go up. Not necessarily. This is where things get very interesting. So let's go into inflation expectations. Inflation expectations are no higher than they were going into SVB and well off their 2022 peaks. Whereas if we look at long end bond, what these are basically is they're the anticipated inflation rate over the next 5 years. In this case, is the 5-year break even. And let's look at we'll make it the same. We'll look at the 5-year bond. The 5-year bond yield is at its 2022 high. Yet 5-year break evens are nowhere near that. What is this telling you? Some people will say, oh, inflation expectations are wrong. They're not making sense. You can say whatever you want. Long story short, inflation expectations, which we believe are the direction of, are more indicative of where inflation will go. Don't look so much at the price, but as the direction, meaning for inflation to really accelerate from here, we need to see break-even rates break out of this chokeout zone, which we have here in yellow, meaning if inflation expectations break out, which they briefly did in February, where everyone was getting scared inflation was going to accelerate, and then came back in with the SVB crisis. So unless they get above this zone, I wouldn't worry about inflation. The other thing, the thing you can say is inflation is currently looking like it's going to remain sticky for a long period of time at this rate. I mean, we're not breaking down at all. We're just going sideways. But that doesn't mean that inflation is going to break out, and sticky and lower is a different story than sticky and higher, right? Obviously, sticky and higher means a lot more Fed work needs to be done. The Fed is in a restrictive state. And this is where this goes back into the actual compound landing. So if the Fed is restrictive, but the market starts second guessing that in terms of the long end starting to lift, right? Because if the market's going to start thinking the Fed's not going to cut interest rates or push rates out further on the curve, what's going to happen is the Treasury is also going to start to believe that there's no recession, right? And if the Treasury says, well, if there's no recession and we need to start issuing debt, what are they going to do? Are they going to sit there and issue debt on the front end of the curve at the most expensive possible price to pay, or expensive yield, highest yield? Or are they going to start to say, well, if there's no recession, we got a target duration, which is the cheapest, right? If we go out on the curve is inverted, meaning the highest yielding bonds are the front end and the lowest yielding bonds are roughly the back end. So they're going to start going to the back end to issue bonds at a cheaper yield because their objective isn't to, I know this might sound like a joke, but their objective isn't to just blindly waste taxpayer money like that, right? They're not going to just take the highest yield possible. They're going to try and be somewhat efficient with their issuances. Obviously, the supply in the market does play a role here, and there's less liquidity further out in the curve, which is why it's easier to move the curve with issuing more bonds. Now, if we look at the back end of the curve, let's go back to the 30-year. The 30-year is, again, like the 5-year, at its 2022 peak. Now, if we're going to talk about rising interest rates and discounting the fact that it's not inflationary driven, we have to give it some reason, right? It's not just, oh, expectations of a soft landing, rates going up. Well, it's this, again, the compound landing, right? This all ties back to the compound landing. So the soft landing is first. Now, I'm going to play this out for you guys. So I know I was probably all over the place. You guys are probably wondering, well, how does this all tie in? And this is how it's going to this is how I think it does play out. Obviously, granted, the regimes stay where they are and the trends stay where they are, which is what we spoke about being the first driver in the soft landing, risk-off regime, and positive equity trends. So let's talk about how this plays out. The soft landing starts to materialize to the market. And everyone realizes there's no recession. If there's no recession, the Federal Reserve isn't going to cut interest rates. Therefore, everyone's going to have to accept a revert or start to think about a reversion of the yield curve. There's no reason the back end should be discounted so much if there's no recession on the horizon. Now, if there's also no recession on the horizon, the Treasury is going to look at that and say, we can issue long end bonds because they'll only get more expensive from here. And they're the cheapest source of liquidity at this point in time. Might be a lot of liquidity, but they can start issuing more and more in the long end, which is what we started to see a few weeks ago in terms of where issuances were going. We're starting to see the long end issuance sector pick up on the offering schedule. We spoke about that last week, and that's something that is going to spook the markets, which it has. And now you have this issue where the soft landing materializes, but all it does, right, it lifts the long end. Equity prices can go up in the process, right? There's no recession. Everyone's had, the market can. The idea, remember, the reason why equity prices can go up in the soft landing and rates going up is the market's thinking that equities can withstand higher interest rates than what's previously thought, meaning 5% interest rate is not so detrimental to what people have thought even just last year. So therefore, equity prices can continue to rise, even if the long end yields are rising. All this does, though, is put more restriction on the economy. Mortgage rates continue to go up, right? Financing across business sectors continues to go up. Company profits continue to get constrained. All this does is put more pressure on the economy while we still wait for the Fed lags to cycle through the economy. Remember, we spoke about that last week. Fed lags have not made it through this economy yet. And that's another reason why the soft landing is masked. It's almost basically fogged. You don't understand what's going on here as the soft landing materializes. It's adding more restrictiveness to the economy, which then, as the compound landing is formed, the soft landing ends up turning into the hard landing. Because what ends up happening is you think everything's so great and so good. You go from underpricing, which we did last year, to overpricing, which is what looks like it's going to happen here in the foreseeable future, where last year we were underpricing the idea. Everyone was, I shouldn't say underpricing, overpricing to the downside. This idea that the recession's here, it's imminent, it's happening, and it didn't happen. Now we're going to basically overprice the upside, that the economy can handle all this drastic change. We're talking about the fastest rate hiking cycle in modern history. We're talking about the attitude that the Fed has is to where they will just sit here at high interest rates. They really want to tackle inflation and make sure it gets back down to target. So this idea that the economy is going to be able to sustain all this would be miraculous if it did. It would be a miracle if it did. But realistically, the odds are stacked greatly against it. Now, what's going to happen here is as the soft landing plays out, the impossible soft landing, people are going to start to lose faith in the hard landing. As the long end starts lifting, people are going to say, well, there's no reason why there's a recession. There's no reason why the long end should go up and equities should go up with it. And they're going to start to say, well, something's broken. They're going to lose faith in this idea and the hard landing. Rates higher are bad for the economy, and they're going to just throw the towel in. That's where the hard landing hits. Now we have another risk factor here. And that risk factor in this whole compound landing is the global soft landing. What does that mean? Simply put, other countries that are experiencing sustained growth, resilient growth, I should say, they're going to run into the same issue that I'm talking about here, except they have a whole nother issue on their hands. They have United States debt. And a good example of this is, in fact, Japan. So Japan, let's just say their economy is heating up, right? Their growth is, they're actually outgrowing China at this point in time, percentage-wise. Now, as they're growing and inflation remains sticky, everyone, the BOJ is going to be faced with this issue of actually having to raise interest rates. Now, if they raise interest rates, obviously what they're going to do is they're going to have to defend the Japanese yen. Defend the Japanese yen, they need to swap dollars for cash, which means they have to sell their treasury holdings. To sell their treasury holdings, they will therefore push long end yields higher. And just to give you an example, Globally, there's about $7.5 trillion of foreign treasuries outstanding. 7.5. And nearly 50% of it is duration. Now, I'm not telling you that this is going to be a main duration driver. I'm telling you that this is additional risk for the long end of the yield curve if it were to play out like this. If a recession doesn't come for these nations, for example, Japan, before this. If Japan has to raise interest rates, they're likely going to do so because the yen is falling apart, inflation is a concern, and growth is hot. They have a hot economy that needs to be tamed, and that's done by raising interest rates. Otherwise, things get too hot. Now, if they do start raising interest rates, they're going to reshore the yen. Yen is going to come back into the country, and they are also going to most likely at the same time have to defend the currency with selling U.S. treasuries in this scenario. So that's another factor you can put on the side and say that's upcoming risk. That's not just for Japan; that's for any other country that is experiencing above trend growth and moderate slash not excess, or I should say above trend growth and very low policy rates, or under adjusted policy rates, meaning where they have to hike further. And that's something that we have to pay attention to. Now, this all leads back into the hard landing, or again, the compound landing, where both come together. Once the soft landing materializes and everyone says, well, I don't see the hard landing coming, I can't see the hard landing coming. That's usually when things happen, when they say they can't see things coming. So I want you guys to focus on the grand scheme here. If bond yields go up, as they have been, it's just a sign, especially in the long end, that the yield curve is reverting, right? Let's take a look here. The yield curve is slowly climbing up. Well, the economy must be the recession must be close. It is. But first, we have to materialize the soft landing. And once the soft landing gets materialized, what's going to happen is the economy is going to become so restrictive where the Fed is going to actually have to reduce rates on the front end. And that's when they pancake the front end of the yield curve. And everyone says, oh, yeah, QE. That's when QE comes in. This is most likely going to fool a lot of people thinking the recession is coming without actually coming until it's later on in the process. Typically, these reversions, right, these moves up in the yield curve spreads are the recession taking place. What I'm telling you is there's a good probability that it happens in a unique way this time due to policy lags and the way the soft landing would or is expected to materialize in the economy. And then again, we can even look at, like I said, GDP. GDP is so hot, everyone's thinking, okay, this is not recessionary. And if this is not recessionary, remember, long ends have to go up. And if all of this plays out, what's going to happen is the dollar should remain weak, right? The US dollar. I should say the dollar should remain in bearish trend, right? Excuse me, let me pull up the futures. We use futures here because they have a liquidity feature which DDAP uses. So obviously you can see DDAP is bearish trend on the dollar right now, and it will likely sustain bearish trend for some time until the hard landing takes place, where there's a surge for US dollar demand, aka treasuries. Until that happens, higher dollars are not or higher dollar value is not likely follow the trends. Remember, this whole entire theory, the compound landing, everything from the compound landing to the soft landing to the hard landing, is designed off of our tools. These are not things that I just think about one day and say, this is what's going to happen. They're aligned. Remember, for the soft landing, we have to have a risk-off environment, positive equity trends. It has to be deceiving. The idea that the economy can land softly, think about that. It's the whole plan of deception. That whole concept is deception. And that by itself, risk-off economy, risk on stocks is deceiving, and it has been. And same thing with the dollar. If you want a recession, you need a dollar in a bullish trend. Dollar's not in a bearish trend. Odds are you're not going to get that recession that you're looking for. And if you're not going to get that recession, what's the market thinking? The market's thinking the soft landing. And the soft landing will continue until complete faith in the hard landing is lost. then the hard landing will emerge. And as usual, everyone will say, who could have seen this coming? Thank you so much, guys, for listening. If you have any questions, feel free to reach out to us on Twitter at The Market Radar. We hope to talk to you in our Discord chat. We have a free version available, but we also have a dedicated room to members where we discuss macro topics daily. More information on that can be found on our website at market-radar.com. Thank you so much, guys. Have a great week.